Hello, welcome to the final compliance update for the year. I know that will be a sad realisation for a lot of you, but nothing too heavy in this presentation. Just a bit of a recap as to current state of the nation and a bit of a look through some of the findings internally within the group. As well. So also welcome to any new advisors that I haven't had a chance to meet, and just welcome aboard in general. And I hope you're enjoying your time with us so far. And if there is any compliance or advice type of questions, please feel free to pick up the phone or email me. Happy to help or set your mind at ease with any questions that you may have in relation to process or house rules, etc. Okay, so we'll just have a bit of a look through the agenda item. We'll look at what the regulators have been up to, some of the most common audit issues that we're seeing as a result of the surveillance from our own internal network, touch on a few advice topical areas, longevity risk, client electronic transactions or transaction requests, and a couple of other bits and pieces there as well. Excuse me. So the ever vigilant ASIC are, of course, have some themes that they're continuing to follow for the remainder of this year and into next year as well. And typically they release some big reports or some big findings, and then the results of that filter down across the Insto and then to the IFA network and so forth. So ASIC released a report about how institutions oversee their advisors, and it addressed a whole lot of different things around onboarding, recruitment, due diligence, CPD training and things like that. So that's some of the findings of that will of course affect our group, like all groups, and we'll have a bit of a run through those a bit later in the presentation. The accountants are well and truly in ASIC's site over a number of areas around through the advice chain, but particularly around SMS of advice and sophisticated investor certificates and things like that. But once again, we'll have a look at that a bit further down the track in the presentation. Life insurers also, not sure if everyone realises this, but life insurance companies are required to send ASIC a net lapse rate report every month. So the advisor doesn't necessarily see it; it's issued at a dealer group to dealer groups. Or we're CC'd, and it's probably a better way to put it. So, and what it does, it picks up net new changes in net new business with a particular provider of 20% or greater. So, if your name appears on one of those reports, it doesn't necessarily indicate there's any churning or untowards behaviour at all. I mean, it's a pretty blunt report in some regards. It simply looks at net new business for an advisor with a provider. So if you've got a small amount of business with an insurer and you replace a couple of reasonable sized policies, there is a chance that your lapse rate will exceed 20%. It's no big deal. You just need to be mindful that if someone does give you, knocks on the door or contacts you, you've just got to have obviously the reasonable basis to support the assumptions made in the business, which shouldn't be an issue. But for advisors that are churning, for want of a better word, ASIC it's a very good tool for ASIC to pop the bonnet and go in and start their surveillance. SMSF surveillance and shadow shopping, that's continually under the microscope at the moment with ASIC. A lot of the times we're hearing word from the field that when accountants or accounting firms are setting up trust deeds for SMF trustees, the ATO, before they will release the AVN, etc., ringing the trustees asking a series of surveillance types questions, which we're sure they're passing on to ASIC around who recommended they set up a super fund, were they given an SOA, and all those sort of things as well. So keep in mind they're all over it. Competency standards for advisors, that's sort of, I suppose, an offshoot of the ASIC surveillance into licensees overseeing their network. So we need to be more vigilant around that, and we'll talk through that a bit further in the presentation as well. So what we did was we had a look at some of the more prevalent or repeat issues that tend to come up in audit results from our own network, and there's nothing in here that's surprising or complicated or any sort of, there's no gotcha moments. It's just basic sort of stuff that tends to rear its head. So one that does come up from time to time, or quite often, is consideration of alternative products and strategies. So just to be clear on that, just make sure your SOA contains at least one alternative strategy. If you're recommending a client undertake a particular strategy in one area, and the strategy needs to be a bona fide strategy. It can't simply be, we considered doing nothing. It's not really going to stand up. It needs to be genuine. So an example of that might be, if you're recommending a client make additional contributions to super, you might compare that to reducing the non-deductible debt on their home loan, and just sort of establish why you've recommended the super contributions over the reducing the non-deductible debt. And just in relation to alternative products, that's obviously been around forever, but just to be clear, within your client file, if you're recommending, for example, a client take out an insurance policy with one provider, just have your research on file to with another provider, looking at have a quote, and we went with the provider that we recommended because of these reasons. We considered others, but this recommendation is your best interest because of this. You don't need to put the other quote in the SOA or go into too much detail on the SOA. You just need to have evidence of it in your working papers. The other one that comes up from time to time is, just to be clear, is with reasonable basis, best interest obligations, the like-for-like comparisons. Just make sure that if you're recommending one super fund to another or one investment to another, just needs to be the same dollar amount. Otherwise, the comparison won't make sense to the client. The client just needs to look at the SOA, run their eye down column A and B, and see what the cost is, and the benefit and features of one product versus another. And if you do them on different dollar amounts, obviously it's not going to make sense. The client needs to be able to look at it quickly and easily to make their decision and sort of understand your recommendations. And the other one as well is just, I know I bang on about this all the time. You guys are probably sick of hearing about it, but we just can't stress file note, the importance of file notes. Not so much as it's not really a compliance issue as such. It's more of a good business practice exercise, in the event that the practicalities of the real world are that the excess on the PI policy, the group PI policy, is $25,000 per advisor per complaint. If it goes to FOS, fees start at $3,000 and go up to $9,000 as well. And what we found, our experience has been, in the event of a PI, a FOS claim, or any sort of complaint, if you haven't got a diary note, it's very hard to prove a point, and it's particularly hard with FOS because there probably is an indication or a leaning towards, within doubt, believing the client's recollection of events as opposed to the advisor. Don't know if that's true or not, but that's certainly the feeling that we get when we've seen cases come across our desk. So record keeping is paramount. And with a file note, it doesn't have to be war and peace. Really, you just want, for example, if it's an initial meeting file note, where were you? What was the date, the location, who attended, what was the topic, what were you talking about, and what was the outcome? The clients were happy to proceed. They asked a couple of questions about investment markets. Just capture their mood if there's anything that you think is worth noting it, or if they had a particular concern about something, if they were happy, those sort of things. Just can be 5 or 6 lines would suffice to file note in most cases, unless it's something quite complex, like an estate planning scenario, and or so forth. Okay, so the other focus that's topical, really not so much from a regulator's perspective, but just in general in the advice landscape, is longevity risk. So we just need to be mindful when you're recommending a client hold insurance via super, that you make mention and acknowledge longevity risk, and you acknowledge that that the purpose of superannuation is to fund a client's retirement, the sole purpose test. So you need to ensure that if you're making recommendations for a client to fund insurance premiums via super, the best practice or the practical way to deal with that would be to put a recommendation in the SOA for the client to salary sacrifice the equivalent amount that's deducted in premiums back into superannuation. Goes without saying, but you obviously need to do your normal due diligence and look at the client's contribution limits and how much they're already contributing to super. So if they're already contributing up to their limits, you obviously don't need to make a salary sacrifice recommendation, but you do need to address it in the SOA. Okay, so most advisors are doing that. It's not a big issue. Most people are doing that in the SOAs, but please just be mindful of it. If you make recommendations to hold risk via super and you're silent about it, you leave it out, it's probably going to come up as a problem in the audit, and it could cause you some problem down the track as well. The clients, you can't obviously force a client to take up salary sacrifice recommendations, but it is prudent to put it in the advice document that they consider it to offset those longevity risks as well. Okay, so most practices are doing this anyway that we've spoke to, so it's probably not going to create an issue or any contention or anything like that. And we've spoken to quite a number of businesses and within the network, and they're doing this anyway. It's just a common sense approach. But in relation to client withdrawal transaction requests, and it's typical, all of you have clients that are in pension phase or drawdown phase, or older clients that are retired, and from time to time you'll get an ad hoc email saying, I need some more money for whatever, and they would typically maybe send you an email, and you'd send them the relevant form or whatever the process is with the underlying wrap provider or master trust or whatever it is, wherever their money's sitting. You just need to also, if you receive an email from a client, just pick up the phone quickly as well before you actually release the transaction and say, hi, Mr. Client, I've received your email, just confirming that that we'll do that for you, and just confirming the amount, etc. Because this is actually off the back of a fraud or an attempted fraud case within the network about 3 or 4 weeks ago, where we had an advisor who received a client withdrawal request, a very large withdrawal request, several $100,000 in this case, and the client the purported client sent an email to the advisor to do the withdrawal request, and the advisor complied with that request. However, the administrator or the wrap provider, whatever it was, the underlying platform, picked up, due to their checks and balances, the client had listed a different bank account that was previously on file, and then the advisor verified with the client, and it turned out that it was actually a fraudulent request. The client's email was hacked, and this was obviously circumvented before anything actually happened, but the request nearly got processed, and email hacking is becoming more commonplace all the time. If you talk to any of the product providers and the wrap providers and your premiums, all those sort of people, they'll tell you that they get these fraud attempts on a daily basis, and the only real way to put a check and balance in place is to actually pick up the phone and call the client. Every advisor I've spoken to about this calls the client anyway and just quickly confirms that that they actually did send the email. So obviously this is only requests that you get via email. So a client comes into the office, it doesn't apply, but any electronic requests need to be verified by phone. And once again, common sense. If something goes wrong, there's a PI insurer involved as well. So, and you've got the excess there, so you need to ensure that you make the transaction request in line with the business rules as well. So, okay. So as I alluded to before earlier in the presentation, that ASIC are very much looking at competency of advisors or continuing competencies and how dealer groups and AFSLs monitor that and how vigilantly they monitor that. So what that means in practicality is that it's no longer an option to leave your CPD requirements till the end of the financial year and find your login and just start knocking out your CPD points. They expect you to be competent all year round. And the reason for that is if there's a piece of change in the legislation or the federal budget which impacts your clients, they expect you to be able to demonstrate that you're up to speed with all the requirements in order to provide advice. And the other thing that they can do, and they will start doing more so from time to time, is going to dealer groups like us and popping the bonnet and saying, we want to see a list of all your advisors and their CPD progress at any particular point in time. So, we're obviously obliged to send them that. And if, you've got no CPD training completed on the register, guess what? ASIC are going to be, if they're going to have a look at someone, they'll start there, and that's be a starting point for them to, do an investigation or do their surveillance. So that's not really a list that if I was an advisor, I'd want to be on. So we haven't, given that we've just reignited the relationship with Kaplan this year, we've given everyone a chance to get registered and get familiar with the system again and so forth. But from January next year, we will be looking at that quite regularly, and we'll be expecting you to maintain your competencies on a real-time basis there as well. Okay, so the other issue that ASIC are quite vigilant about, and they've been vocal about in their media releases and so forth, is their concern that retail investors in some cases are being inappropriately classified as sophisticated investors, particularly by some accountants as well. So look, we realise from time to time you'll generally get a sophisticated investor that more often than not it'll be in a one-off investment type scenario where there's a genuine reason for them to be processed, if you like, that way. And so long as there's a certificate from the client's accountant, a current certificate, we're okay. You obviously need to send through the details, but with one-off requests. But what we're not okay with, and most dealer groups are not okay with, is clients being processed as sophisticated investors, really. So you don't need to undertake the normal client requirements in terms of the advice documents and so forth that a client would receive in a normal advice relationship. So keep in mind too that retail clients, as you'd be aware, there's various mechanisms under the Corporations Act and the ability to engage a dispute resolution scheme. All these protections are afforded to retail clients. A client loses all these protections and rights for redress if they're classified as a sophisticated wholesale investor. And you need to be very conscious of that when dealing with clients as well. So, and from a realistic point of view, from a business model valuation, businesses that receive a good sale price and a good valuation are businesses that have advice-based businesses that have good systems and a good methodology in place around providing advice. Having a transactional business model where you're rubber stamping things for clients and putting them through as wholesale investors does not lend itself at all to achieving a strong business valuation. So I think you can probably tell there what our house view is. From time to time, they may come up, they may be genuine, but more often than not, we'd expect clients to be treated as a normal retail client, and therefore it's better for you guys as well because you're charging fees, and at the end of the day, you're achieving a higher business valuation as well, which is really the end game, is what it's all about. Okay, just quickly an ROA refresher comes up from time to time. Still a bit of confusion sometimes when you can use an ROA as opposed to an SOA. So an ROA can be used with an existing client, cannot be used with a new client. There has to be no significant changes in the client's personal circumstances since the last SOA was provided, and the basis of the additional advice is no different than the basis of the original advice. So typically an ROA is going to be used for we saw here today to review your portfolio. We're going to rebalance, or we're going to leave it as it is, and confirming that the advice is still appropriate. It's not to be used for introducing new products or new strategies, and it's really just almost a confirmation document that what we've recommended previously is still relevant to your circumstances. There's no definition, obviously, in the Act about what significant changes are. It's up to you to use your professional judgment, but I think most of us would have a fair idea what the difference between significant and not significant is in that regard. Okay, so just the other bit too on ROAs, just keep in mind that ROAs under the Corps Act are to be provided like an SOA under the best interest obligations. So in practicality, that means that you need to include in your SOA that the same text that's in your ROA about this advice is in your best interest because, and if you don't follow our advice, the risk is this. So just cut and paste, if you like, the best interest requirements from the SOA template into your ROA, and you've met your requirements there in terms of how the document presents itself. Okay, and finally, we'll just touch on UK pension advice. We had BDH Sterling go around to most of the states during the year to provide an update on how they can deal with this scenario for your clients. Because of the changes to cross-jurisdictional legislation, used to be just a cure-ops fund would suffice in most cases to do the pension transfer, but it's got a lot more complicated than that now. So we are making it that you need to refer UK pension advice to a third-party specialist. BDH Sterling is our approved third party in this area. They're well established with a lot of experience on the technical side of things, both having offices here in Australia and the UK as well. So just keep that in mind if you come across those particular cases. And as a touch point, they're good guys to actually speak to, even if it's just a general client inquiry that may have one of those needs. Look, that's about it. It's just a bit of a quick update, as I said. And please, if you've got any questions off the back of this update, shoot me an email or drop me a line, and I'm happy to help. Thanks again for your time, and have a great Christmas, and stay happy and healthy and all those sort of things. And I look forward to touching base with everyone next year. Thanks very much, guys.